Hello, this is Henry of AutoAnalysis. Welcome to the first edition of the Production Outlook Review for 2013. Happy New Year. Let us start with a look at what happened in 2012. Well, our provisional 2012 European production total, including Russia, is 18.1 million, which is a million down on the 2011 volumes. Without Russia, Europe was 17 million, which is down 1.4 million. The importance of Russia is therefore very clear. A total collapse in production was prevented by modest growth in the Czech Republic, Hungary, Romania and the UK, and indeed a boost in production in Slovakia due to the start-up of the Volkswagen Up series. The big losers in 2012 were Spain, down 468,000, Italy down 122,000, France down 346,000, and even Germany down 545,000. The larger-than-expected fall in Germany was due to market decline at Ford and Opel in particular, and model cycle effects of Mercedes and indeed Audi, where the A4, A6 and Q5 have much less good years than they had in 2011. And also Volkswagen was negatively affected by the switch to the new Golf. Looking forward now, the recovery highlights. Well, first of all, Germany will recover, and by 2017 it will be back to its 2007 peak. But in the long term, France, Italy and Spain will be the losers. France will be down around 30%, or 900,000 annually on the 2007 level. Italy down around a third, that's around 390,000 down, and Spain down around a fifth, that's around 620,000 down on 2007. The eastward shift in production continues, and between 2012 and 2017 the Czech Republic will grow by around 18%, Hungary by more than 140%, that's because of the growth in particular at Mercedes, Romania will grow by 39%, and Slovakia up 9%, possibly a little bit more depending on how much investment goes in at Kia. And here in the UK, production is still growing, and we think it could grow by as much as 25% between 2012 and 2017. That is, if Mini, JLR and Nissan in particular fulfill their expectations. The UK could easily reach 2 million a year. Now a chart summarising our base outlook for all countries, including Russia. Russia is the dark green band in the middle of the chart, Germany is the blue band towards the bottom, and the UK is the pink band at the top. You can see that, including Russia, it looks as though the market recovers well from 2014, but the reality is without Russia, it's somewhat different. As we say, without Russia, the picture is rather less attractive. What we've done here is we've taken Russia out of the totals from the previous chart, and you can see that it takes until 2016-2017 for Europe to recover to its 2007 peak. We've got three other scenarios there, the pink, the yellow and the turquoise line, and that takes into account a decline of between 1% and 5% in the markets compared to the falls inherent in the base outlook. But given the state of the Eurozone and the concerns of whether North America will actually address its fiscal issues and whether China can sustain all that boom of recent years, we have to consider, will it be worse, and indeed could it be much worse? What we've done here is we've created some alternative scenarios that look at what might happen if indeed export markets beyond the EU collapse, and then we have varying degrees of problems in the Eurozone. You need to access and read our full report to understand all the assumptions behind this, but the point behind this is to show, first of all, in the gap between the blue and the pink line, the rising importance of Russia in terms of the total production of Europe. The pink line is Europe without Russia, the blue line is Europe including Russia, and you can see the widening gap as the years go ahead. The yellow, the maroon and the turquoise lines at the bottom, they are the alternative scenarios without Russia, and we draw particular attention to the maroon line at the bottom. What happens if Europe continues to decline next year and indeed in 2014 and then only slowly recovers thereafter? We could be in a situation where by 2017 European production is actually less than 17 million. Well, if that were to happen, we think the current industry structure, by which we mean the number of vehicle manufacturers operating in Europe, would be unsustainable. We think there could be a lot more change on the way. Well, structural change is already underway in response to falling sales and production volumes, but this is really taking place at the volume vehicle manufacturers. Well, as we know, European car and LCV markets fell in 2012, and the EU 27 is at a 17-year low. Production at the volume European vehicle manufacturers has been falling significantly, and by that we mean at Renault, at PSA, at Opel, Ford and Fiat, and these brands are facing long-run structural decline as the value brands and the premium market continue to grow. We think there's going to be a new order for the vehicle manufacturers beginning to emerge. We've already seen restructuring underway. Ford, GM and PSA have announced plant closures. GM and PSA have established what we regard as a defensive alliance, but the benefits from this are not yet apparent. Fiat is reorganising its model allocation between its Italian factories. It's slimming them down, but it's not closing plants, and Renault is doing something similar. In the long run, however, we think it's highly likely that both Fiat and Renault will have to cut capacity, and by that we mean close more plants. Although things have changed, well, yes they have, but the key questions remain unanswered. The vehicle manufacturers have certainly accepted that they can no longer just talk about restructuring, they have had to act. We know that Ford and GM are likely to have lost around €1 billion in Europe in 2012, and we think that when the PSA, Renault and Fiat results are announced, we will also see significant losses there. So will the closures that have been announced so far be enough? Can Fiat and Renault really avoid closing factories for much longer? And will Ford, GM and PSA actually have to close more plants? We suspect the answer is yes, they will have to, and indeed that Fiat and Renault will have to close plants ultimately. The other issue is that we think that despite the strength of German and UK premium brands, and despite the strength of Hyundai and Kia and Nissan, we do doubt whether in the long run non-EU exports, by which we mean North America, China and other emerging markets, can sustain European production in perpetuity, especially at the volume brands. All the groups mentioned below, Volkswagen, Fiat and others, are growing production plants outside Europe, and that could have a negative effect on the long-term production plans here in Europe. Thank you for watching and listening. Details are now on the screen telling you how to access the full report. We hope you will look at the full report. If you've got any questions, contact us. We'll be happy to take questions. Happy New Year once again.